Good morning, everybody. Welcome into Mining Stock Daily in this week's long-form episode. I'm sorry we are a little bit late getting this out, just some scheduling challenges, but it's a good one. We have got Jared Dillian back onto the podcast for a long-form conversation. We're going to talk about the status of the markets, what he's currently seeing, and why he's maybe a little bit less concerned of a recession for 2024. But the premise of the conversation is his new book titled No Worries, How to Live a Stress-Free Financial Life. I have finished the book. It's out in about a week and a half's time. It's a great read. It's an important read. A lot of people who may be unfamiliar with personal finance and the markets, and so we're going to talk about this book for quite a bit of time here. Special thank you to Victoria Gold, Fireweed Metals, Arizona Sonoran and Copper, and Visa Silver for their continued support of Mining Stock Daily. Again, if you wouldn't mind hitting that like, subscribe, and sharing this content with like-minded investors and your friends, we'd be completely grateful for it. All right, here's Jared Dillian. Let's talk about being stress-free with our financial world. All right, here we go. Hey, good morning and good afternoon, wherever you are in the world. Thank you for joining us here on this Mining Stock Daily long-form episode this week, albeit a little bit delayed. That's on me. But we're happy to welcome in Jared Dillian. Most of the times we talk to Jared Dillian, he's the author of the Daily Dirtnap. He still is that author. But he's got a new book coming out in about a week and a half's time called No Worries, How to Live a Stress-Free Financial Life. Jared, welcome to the podcast. And first of all, congratulations on getting this thing going.
Thank you. Thank you.
I was talking to you a little bit, before we pressed record, but, you're no stranger to the podcast. I get to talk to you quite frequently and also read your newsletters. So I get to, I'm in connection with you almost daily anymore, it seems like.
Yep.
But what's funny is that, I'm reading through this book and obviously reading through your newsletter and talking to you. Your writing style is so similar in this book as it is to the newsletter, as it is the way, you communicate to us on the podcast. And, have you ever thought about that style and where it comes from?
There's something in writing called voice, right?
Mm-hmm.
If you read somebody's writing, you can say that it has a strong voice or it has a weak voice, but there's this concept of voice, that there's an urgency behind the words and somebody is saying something. And when I'm writing first-person nonfiction, I have a very strong voice. It's really what I do best. I mean, I write other stuff. I write fiction and short stories and stuff, but really what I do best is first-person nonfiction. Its voice is really about the connection between your brain and the keyboard, right? Mm. And some people have a filter, right? They have a filter between the brain and the keyboard, and the things that they're thinking don't make it out onto the page. I have no filter. It just comes out. So that's, it kind of sounds like I'm bragging, but that's really what I'm good at, is that first person nonfiction voice. So
yeah. Well, and for a book basically more or less about the financial markets and investing, and all that, and really about money. What this book does is very differently from other books I've read that say were published, in the first half of the 20th century, is that, grammatically there's a drastic difference that we're seeing throughout the board here. It's not necessarily like an Adam Smith style of writing or Mises or something like that. I mean, how has this changed? Do you think more authors in the financial realm have just been able to kind of open up and use their own brand and their character and their personality within these books anymore?
Well, there are a lot of good writers in finance. There's a lot of smart people in finance. There's very smart people in finance, and you do get a lot of good writers. Speaking from somebody who has a writing degree and has been exposed to a lot of different people's writing and a lot of different stuff, I think that a lot of people in the finance world actually wouldn't really hold up outside the finance world, So There's, there are some good writers in finance. The guy that everybody talks about all the time is Morgan Housel. I'm a fan of Morgan Housel. He has a different style than I do, but he's very good. But yeah, there are some very good writers in finance.
This is the first book on finance you've written, which people may find maybe unfamiliar with you and your work and will find surprising. Why is this the first?
Well, everything's been kind of like finance adjacent, right? So, Street Freak was a memoir about working at Lehman Brothers, which is finance adjacent, and All the Evil of This World was a novel that takes place on Wall Street, which is also finance adjacent. Those bastards didn't have anything to do with finance at all. This one is like a how-to financial book, which is the first one that I've written. And I hope to do more of these. It's an interesting question. Like, why did I take so long to do this? I don't know. I mean, really, this comes from 2018. I decided I wanted to focus more on personal finance. I found it a lot more interesting, and I thought I had some ideas that could help some people. So then I had my radio show from 2019 to 2021. And for 2 hours a night, I was sitting in front of a microphone and really just talking through my ideas. And that's where I got the idea for the book. So
okay. Oh, there's a lot of takeaways from this book. And listen, it's and I think you did a good job of explicitly stating in the book, this is not a how to get rich book. This is more an educational, informative book. I mean, you do provide some tangible ideas towards the end. You titled your awesome portfolio, and obviously we'll talk about that in due time. But the premise of the book is I don't want to say simple, but it is meant for an audience that maybe is interested but is unfamiliar with not only markets but also personal finance. And this is something they haven't taught in schools for quite some time.
Yeah, I mean, ultimately, I would like this book to be used as a textbook in schools.
It fit perfectly.
Yeah, it would fit perfectly. I taught a personal finance course at Coastal Carolina University in the fall semester. My book hadn't been published yet. I couldn't use it as a textbook. Going forward, I'm going to use it as a textbook. But really, anybody who is teaching finance at the university level, or even high school seniors or juniors, I think, are sophisticated enough to read this, should really think about using this book. Before we got on the podcast, I asked you, I said, do you think this would be a bestseller? And what you said was, this really needs to be in the hands of young people. So, if you're listening to this and you have kids who are juniors or seniors in high school, or they're in college, or young adults, 25 years old, something like that, this book is really an ideal gift. And the one comment that I get from people all the time, people who have read this, like especially Tony Greer, like Tony Greer said this to me because he blurbed the book. When I gave it to him, he's like, shit, I should have read this when I was 25. Like, I really wish I had this when I was younger,
Yeah, exactly. Yeah. But what's important is this is it's not only informative, but you put a real stress on, it's called no worries. So why we shouldn't be worrying about money. And, I'm as guilty of this, but often too many people do stay up at night and worry about money and all forms of the money it comes from, all forms of assets. And so there is a little bit of a philosophical approach to this, a therapeutic approach to this, if you were, Jared. But let's, why we, I guess maybe that's a little bit of the difference between this book and others from peers and colleagues. Why was it about happiness that was really the premise of this book? What made you think about that?
Well, if you go to the bookstore, which there aren't many bookstores these days, but if you went to a Barnes and Noble and you went to the personal finance shelf, you see a lot of books like 10 Easy Ways to Become a Millionaire and 12 Easy Ways to Become a Millionaire and stuff like that. And, I follow pretty closely people like Dave Ramsey and Susie Orman and Robert Kiyosaki. And what I find is that, if you're looking at this from a framework of how to have the most money, their advice is not terrible. Like, it's not that bad. If you're looking at this from a framework of how do you minimize your financial stress, a lot of the things they tell you to do actually increase your financial stress. and they put you in a position where you're thinking about money all the time. And that's really the point I wanted to get across in the book, is that if you're thinking about money 50% of the time, you are doing it wrong. You have structured your life in such a way that you are thinking about money all the time. You should be thinking about money 1% of the time. You should really not be thinking about it. I work in a job, with my financial newsletter where I have Bloomberg up and I'm, watching the markets all the time. But when I walk out of here at the end of the day, I do not think about money. It doesn't occupy my thoughts. And I don't lay in bed at night thinking about how I'm going to pay for the new house or mortgage payment or credit card bills or anything like that. I just do not worry about money. I have a healthy relationship with money. And that's really the goal of the book, is to have a healthy relationship with money, because so many people don't. So people, it's an obsession for people. They either spend too much or they spend too little. The goal is to be in between.
Yeah. Living within or outside of your means, I think, is another way to put it. And we could talk about that, as about how we kind of get there, and really what the status quo of content that a lot of people consume on social media and how that's changed over the last 10 years. But I want to go to this story here, which made me really chuckle, about your relationship with money, your relationship, Jared, and how that changed earlier in your life based on a pair of Prada boots.
Yeah.
What was it? What was it about the boots? I don't even know what a pair of Prada boots look like. I've never been in the market for a pair of Prada boots, but what was it about these boots that really caused you to change that relationship?
Well, just for a little background, this was 2012, so I had been out of Lehman for a couple years. I had the Daily Dirtnap. I was making 400 grand a year, something like that, with the newsletter. It hadn't really taken off yet. It was still pretty small, but it was growing, and I had some money saved up from when I was at Lehman. So I was in decent financial shape. And I was in San Francisco in 2012 for a wedding, and I was walking around Union Square just killing some time. And at this point, I don't know anything about fashion brands. There was a Prada store. I didn't even know what Prada was, but I went in the store, and there's a pair of boots on the shelf, and I was like, oh my God, that is the most beautiful pair of boots I have ever seen in my entire life. I got to have these things. So I picked them up, and I look at the price tag, and they were $1,000 boots. Now, keep in mind, up until this point, I have never spent more than like $80 on a pair of shoes. I was wearing like $80 Johnston and Murphy, like middle brow loafers, whatever, just cheap shoes. So I walked out of the store and I walked around the block a couple times, and I was like, because at first my reaction was, I'm not paying $1,000 for a pair of shoes. And then I walked around and I'm like, you know what? Like, I can afford it. Like, I can afford it. I make enough money. I can afford a pair of Prada boots. Like, I can do this. And I went back in the store and I bought the boots and I took them home and I wore them everywhere for a number of years. And that was really the moment at which I stopped being a cheap bastard, right?
Yeah.
Because up until that point, I just did not spend money on anything. If I bought a shirt, it was like a $40 Brooks Brothers shirt, or like cheap pants, or I had a cheap car. In the book I called them a CF, a cheap fuck, and I was like a really big CF. And this was the first time that I really stepped outside of that and said, okay, I'm going to have a healthy relationship with money. I can afford the boots. I'm going to buy the boots.
Well, but why were you such a cheap fuck from the first place? Which is interesting, because you mentioned you were living in New York and working at Lehman Brothers before you bought those boots. And a lot of people would expect, like, well, a Wall Street banker, they're living the high life. We've seen all the movies. We see how they operate at night.
I was not. So I was living in West New York, New Jersey, which is a Cuban neighborhood. It's a nice place, but it's cheap real estate. I bought like a 1,600 square foot like row house in West New York. It was $430,000. So keep in mind, I'm making $850,000 a year, and I'm living in a $430,000 house. If your income is 2 times the value of your house, you're doing it wrong. Okay, like, you're doing it wrong. But I lived in this cheap house, and my mortgage payment was like $1,800 a month or something like that. And I was just saving and saving and saving. And I was not a big spender when I was on Wall Street. I was really cheap. I used to bring cans of like pork and beans to work. You had these guys on the trading floor, they would order lunch from like Bobby Vans, and they would order steaks for lunch. And the steaks were like 40 or $50. And they would spend $40 a day on lunch, like ordering in lunch. And I would bring in a can of pork and beans that cost 69 cents. And I had a can opener at my desk. And I would eat it with a plastic spoon. So if you think about the absurdity of that, somebody who's making almost $1 million a year that's eating like pork and beans on the trading floor, but that's what I did. I was really, really cheap.
Yeah, well, it's really fascinating because, I mean, what was your relationship like with coworkers? I mean, I'm sure you took some shit.
I took some shit, but I gave it back.
Yeah.
And like ultimately, my approach ended up being the right approach in the short term because, those guys, spent cash like they were going to the electric chair, and then Lehman went bankrupt and they were stuck. I had a lot of savings, and I hadn't leveraged up on my house. I didn't have a lot of financial leverage, so I was in good shape.
Yeah. Oh man, that's just such a fascinating story. I also like the idea of, or this not idea, but the story of how you got to Lehman, and specifically how you got yourself to Wall Street. And it reminded me a little bit of, looking back on my own career retrospectively and thinking about the ability and willingness to take risks on yourself and just say yes. Putting yourself in positions where you're going to be uncomfortable, but there is a risk reward there for where you're at. And you kind of talked about how you got into Wall Street, and had was it a Coke bottle or a water bottle that almost hit you in the head, and somehow you got a job out of it. I mean, it was just fascinating. But I think you mentioned a lot about risk in the book. Financial risk, investment risk, all this risk. But I think hidden in the synopsis is taking risk on yourself, right?
Yeah, well, first of all, with regard to the story about me getting a job on Wall Street and the water bottle and stuff, the idea is to put yourself in a position where you can be positively exposed to luck, right?
Okay. Yeah,
Like,
that's right.
I'm in my office right now. Nothing happens to me in my office. Yes, I publish my newsletter and I'm on Twitter, and I can get opportunities that way. But really, like, the way to be positively exposed to luck is to get out into the world and get exposed to other people, go to conferences, go to parties, meet people. That's where you are positively exposed to luck. I can't remember if I put this story in the book or not, but Madonna, when she was 18 years old, she moved to New York City, and her plan was to walk around until she got noticed. Right? So she put on all her sexy clothes, and she was 18 years old, and she just walked all over Manhattan for days until somebody noticed her and gave her an opportunity. Right? Which I think is the
Wow.
coolest story of all time. Like, nothing happens to you when you're in your apartment. Nothing happens to you, and you have to get out there and do stuff. So I think all the time about getting positively exposed to luck.
Yeah. Oh, I didn't know that story about Madonna. That's
Yeah.
fascinating. I did not know that. Um, okay, so we got Prada boots, we got a water bottle thrown at you, we've got your start on Wall Street. You've made this transition from having those alligator arms with your money to being open and knowing where you were in relationship with your money. But it goes much deeper than that. And, I think this is a lot of times when you start, communicating, starting writing your newsletter. But there's a lot of big ideas, not only within the newsletter and how you're communicating with people, and obviously, having these side businesses with writing these books. But I want to ask you about some of the major themes in this book that you're communicating to the readers, and that is a relationship with debt and understanding of debt. I also want to talk to you a little bit about this fear of recession, because I think that's obviously very timely right now. You write a little bit about gold. Honestly, my biggest critique is you could have written a lot more about gold. But and obviously this idea of being a bad customer of the bank, which is a
Yep.
theme I actually used in a personal conversation of mine just last week. Jared, I think it was like, oh, I'm going to quote Jared Dillian here in this conversation. You should be a bad customer of the bank. But let's talk about debt, where we are with debt, the relationship with debt, and the ability to be fearful of debt, but also be respectful of debt.
Yeah, you should have a healthy respect for debt. I mean, first of all, if you look at a guy like Dave Ramsey, he says debt is evil and you should never have debt. Okay. It's a stupid approach, right? Like, we're all going to have debt at some point in our lives. You can accomplish things with debt, right? One of the things I say in the book is if you walk down Madison Avenue in New York City and you look up at all the skyscrapers, those were not built with equity. They were built with debt. Like, lots of things have been achieved with debt and everything worked out fine. But you have to have a healthy respect for leverage and having too much leverage. And having too much debt can cause financial stress. Really, that's the chief activator of financial stress is debt. And for a lot of people, it's credit card debt, having 30, 40, 50, $100,000 in credit card debt. They got to make the payments every month. They're making minimum payments. The interest is compounding. They're negatively compounding interest. They bought too big of a house. They have an enormous mortgage payment. Their HOA fees went up. Their insurance went up, and they have trouble making that monthly payment. Like, these are all sources of stress, right? So you can use debt to accomplish things. Like, it's very hard to buy a house without debt. I mean, very few people can do it. So you can use it to accomplish your financial goals, but you have to have a healthy respect for it and pay it off as quickly as possible.
But you said there are best uses for debt. What are some of those best case scenarios to bring on more debt in your life?
Did I talk about that? Best uses for debt? I mean, certainly buying a house for sure.
Yeah. Maybe it's a note that I wrote. Maybe it was a question I wanted to ask you in my notes, but I wrote here best use for debt. So maybe that is, I know buying a house, but what is the other best uses for debt? Obviously not investing. You refuse to become leveraged.
Yeah, I mean, student loans are really the worst kind of debt because you can't discharge them in bankruptcy. So if you take out $200,000 in student loans and you can't pay them off, they're going to follow you around for the rest of your life. In the book, I talk about you should never take out more than $40,000 in student debt. If you graduate from college and you're making $60,000 a year, you can pay down $8,000 a year. It's about 14% of your income, not a problem. You can pay off $40,000 of student debt in 5 years. The goal is to pay off your student loans in 5 years, right? If you can't pay off your student loans in 5 years, you did it wrong. You borrowed too much money.
I remember reading that and I was like, this is like a Kaiser So moment, that line in the movie where he says the greatest trick the devil ever pulled was convincing the world he didn't exist. and how that's like a government sponsored Kaiser So moment with student loans, because it's something that's like so automatic. It's like, well, I need to go to school. I need to go to school to get a better job. Any school will do, because if I don't go to school, my life will be hard. I won't make a whole lot of money, but I can't afford school. So I'm just going to go straight to the government and take out a huge loan and not understand what it's going to take to pay it back or understand what those interest rates are going to look like. I'm just going to sign the paper, take the money, and go to school. It's a Kaiser So moment.
Yeah. There's also bigger things here that I didn't talk about in the book. I mean, we currently have an oversupply of people going to college and an undersupply of people not going to college. And it's caused some mismatches in wages. You have people graduating from college who are making 40, 50, 55,000 a year in sales jobs or waiting tables or stuff like that. And you have high school dropouts making six figures driving trucks. And it's all supply and demand. It's the fact that we have an undersupply of people who are not going to college. We actually need less people to go to college, right? And we've told everybody that going to college is the golden ticket. It's the key to your success. And because we have an oversupply of that labor, and it's also a bigger conversation about, like, what is the purpose of college? Is the purpose of college for you to get a job, or is the purpose of college to be educated and enlightened, right? And I think schools spend a lot more time focusing on the latter and not on the former, right? Like, and there are certain majors which are not good for getting jobs. It's a big conversation. So
yeah. Well, I mean, and I'm certainly proud of the education that I received when I was there, but I will say that the purpose of education has also maybe been a little bit transformed or jaded since 20, 30 years ago when I was an undergrad. Like the purpose of the university, I mean, tuitions have gotten so high and so outrageous. You got to ask yourself, well, are you getting a better education, or are you just improving the infrastructure of the university to kind of feel good for 4 years that you're in a good spot, but then you leave and you're not utilizing those facilities anymore?
I can tell you I've gotten my money's worth out of all my degrees, right? My business degree, my MBA, I got a job on Wall Street. I made lots of money. Like, it was worth it. And even my writing degree, which was sort of a luxury degree, this book came out of my MFA program. Like, I wrote the proposal for this book in my MFA program. So, the $70,000 that I paid to go to school, like, I'll make that and then some on this book. And I also got another book out of the MFA program and another book out of the MFA program. So I'm actually monetizing that degree as well. So you have to think about, like, when you're going to school, there's nothing more romantic than graduation day, right? You're in your cap and gown, and they're playing pomp and circumstance, and you get your diploma, and you're crying, and it's just like it's the happiest day of your life. Yeah, that's great, but then reality sets in, and you have to earn a living. So,
yeah. I want to let's talk about this topic of recession. I think this is incredibly timely. There's a section in this book where you write about people's fear of recession. And for people who, I was just starting my career during the great financial crisis, so a little bit of a hiccup there, Jared. And, that recession was so bad, it's engraved in our minds, and so I think this idea of facing a recession here, whether this year, or we don't get a recession this year, it turns into next year. But, I think there's this idea that a recession is going to be just as bad as it was in 2008. And it's because we've lived through it. But those of us that follow markets and business cycles understand that it takes recessions, whether a soft recession or a deep recession, to really reset the cycle to begin another path trajectory upward. So talk about this fear of a recession and what the general people need to understand about recessions to maybe be a little bit less concerned.
Well, the last real recession we had was the financial crisis. We had a small recession during the pandemic, but I don't even think that counts because we inflated our way out of it very quickly. So really the last recession that people remember is the financial crisis, which had the potential to turn into a depression. It could have been really, really bad. It could have been worse. So when people think back, like when you say the word recession to people, that's what they think of. They think of 2008 and unemployment at 10% and real estate values getting cut in half and the stock market going down 50%. And this really like depression-like scenario. Recessions come in all different shapes and sizes. There's mild ones, there's severe ones. When I'm a little older than you, when I graduated from high school in 1992, we were coming out of a recession in 91, and unemployment wasn't that high. It was about 6 or 7%, but people called it the jobless recovery because the economy was expanding, but unemployment stayed high for a long time. They called it the jobless recovery. And I actually, as a response to that, I went into the government. Right? Like I went into the Coast Guard because I said to myself, like, I'm not going to be able to get a job in this environment. Like, I'm just going to go into the government. That affected my decision making. So a recession is a cleansing process, right? Where you clean out all the bad investments, all the malinvestment, and you start over and you have an expansion and you can have a new bull market. The thing about our business cycle is that it's become very long. If you go back to the 1800s, we had a very short business cycle, and we would have recessions every 2 or 3 years, and we called them panics, right? There would be a panic. And now, since really the fiat money era, 1971, we have very long business cycles of 10 or 15 years or more, And really what happens is you'll have a period of 10 or 15 years of expansion, and then you'll have a crisis, right?
Hmm.
And that's the recessions are less frequent, but they are more severe.
Yeah. So the recession, though, let us talk about this idea of where we're at currently. You talked about a recession needed to cleanse these malinvestments. Well, you could make the argument here, Jared, that we've had 10 years of malinvestment ever since, QE, the advent of the great financial crisis. So if we have this debate about an incoming recession being soft or shallow versus deep and hard, given the cycle that we're currently in and seeing all these very speculative plays getting a lot of inflows, wouldn't it take a very deep recession to reset this?
Yeah, I mean, look, I mean, yes, I agree. I'm not really rooting for a recession because it's terrible and people loses their jobs, and also, I think I think it causes political instability. You know, if
Sure.
we were to have a very severe recession right now, it would cause political instability, which I don't think is a good thing. So I'm certainly not rooting for one. But yeah, like there is overinvestment and malinvestment, and from an economic standpoint, a good hard recession would clean a lot of that stuff out, and we would start over. So
Yeah. You talked about when you started investing, you invested with a lot of greed, which is hard for me to imagine actually knowing you now. But talk about investing in your early days and what that mentality was, because I have a very I'm wondering if it's maybe the same mentality I have and trying to get out of currently.
I don't remember saying that I was investing with a lot of greed. I mean, I opened up an Ameritrade account in
Yeah.
1998. I put like 2 or 3 thousand bucks in an Ameritrade account, and I had a subscription to Barron's, and I was basically farming Barron's for ideas and investing in stocks. And this is back when Barron's really had some predictive value, like it was a really good, like an analytical newspaper. The first stock that I ever bought was Philip Morris in 1999. And it really, like, this is my investing style. Like, I bought it like right before the Engel decision, the master settlement, like 250 billion to the states.
Hmm.
And I bought the stock at 19 bucks, and I sold it at 25 bucks, and then it went to 80 bucks. So
Anyway,
so,
you can still make profit when you sell too early.
so that was my
That's
first
great.
lesson. Yeah.
It's, so how did maybe this is a great time to kind of turn into the awesome portfolio here, because I think it's a almost like an incredibly simple way of being happy and having a healthy relationship with your money, being active in the markets, but also not being overly active where you're just following charts each and every day. So talk to me about this ethos of the awesome portfolio and how you came up with it.
Well, where this really comes from is the prevailing wisdom among retail investors is you should buy the S&P 500 index fund and dollar cost average it and hold it forever, right? You should hold it through all the drawdowns, okay? So, over the course of a 40 or 50-year investing career, I mean, we know the periodicity of bear markets and corrections and stuff. Like, you're going to have 6 or 7 bear markets. You're going to have one great bear market. You're going to have multiple drawdowns of 20 or 30%, or maybe even 50%. And the thing about all these corrections and bear markets is that they cause you financial stress, right?
Hmm.
And index investing is really an article of faith. Okay. It's faith. It's the belief that stocks will always come back, that US stocks will always perform in the long run. The returns that we got in the last 100 years, 9% a year, we will get for the next 100 years. But we don't know that. We don't know that for sure. So Vanguard like bases all their marketing around this. They have these ads on LinkedIn. They show this chart of the S&P of the stock market going down, and they say, just hold on. I don't want to do that. I don't want to subject myself to that stress. I don't want to experience 50% drawdowns. Like, it's going to suck. I'm going to be
Hmm.
miserable. you know? So what I developed was a combination of asset classes where you can get almost the return of the S&P 500 really with half the risk. So if you have 20% bonds, 20% stocks, 20% gold, 20% cash, and 20% real estate, this portfolio over the last 53 years has returned 8.1% with half the volatility of an 80-20 portfolio and a max drawdown of 12%. So think about that. You're giving up 1% in terms of performance, but your max drawdown goes from 57% to 12%. And you're getting half the volatility. You're only giving away 1% in terms of performance. Like, why wouldn't you do that?
How much does gold do some of that heavy lifting during the volatile drawdowns?
Gold does a lot of the heavy lifting. I mean, the thing about gold is I wrote a piece in Bloomberg about this a couple years ago. I called gold the Dennis Rodman of asset classes, right? So take Dennis Rodman, right? Dennis Rodman, he's in the Hall of Fame. He's in the Basketball Hall of Fame. He's one of the greatest basketball players of all time. But the thing about Dennis Rodman is he doesn't score. He scores like 4 points a game, okay? So if you had a team of 5 Dennis Rodmans, it would suck, like it wouldn't score. But if you take one Dennis Rodman and you add him to a team of 4 players that can score, the team becomes a lot better because he's rebounding and blocking shots and passing to the other players, and they score more. Dennis Rodman won a bunch of championships. So gold does that. It has this property where it's really not that correlated to anything else. It's not correlated to stocks. It's not correlated to bonds. And when you add it to a portfolio, you reduce the portfolio risk. It makes the characteristics of the portfolio much better, you know. And the returns aren't bad either. I mean, if you go back to 2000 over the last 24 years, like the returns have been pretty good. So,
yeah. Well, if you had investors allocating 20% of their portfolio to gold, that's a heck of a lot better than, you know, the 5 to 10% that everyone's been recommending for precious metals for forevers, from what I can tell. So you would obviously you might actually see a pretty decent uptick in the gold price if people understood that they needed to increase their allocation to gold. I mean, are you having those conversations, you know, with people about, you know, increasing your position in precious metals?
Yeah, I had those conversations. A lot of people tell me, well, I have a 5% position. I'm like, well, you really need to have a 20% position. And the thing with gold is, like, when I first started doing the research on the Awesome portfolio, I started doing it with commodities, okay? And doing it with 20% commodities and 20% instead of 20% of gold. But commodities are negative carry, right? They're huge negative carry. If you're holding a basket, like there's ETFs that invest in commodity indices, they hold a basket of futures, you're paying the roll, you're paying the carry. Like, it gets really expensive, and gold really has none of that. And also gold is a better diversifier. So
yeah. So where do you do say there is room for speculative money, for gambling money? And I think this is pertinent for this podcast because obviously we dive into the very volatile, risky microcap junior exploration stocks. You know, I know you're not one to invest in that sector, in this sector, but you do say there is a amount of cash that you should, or you could, if you wanted to, have allocated for such volatile investments.
yeah, like, here's the thing. Like, I have a theory about this. I don't know. I can't remember if I put it in the book. Most people view investing as a hobby, right? They do it for fun. You know, they read Barron's, they read blogs, they buy newsletters, they, you know, buy stocks, they like to screw around. All of this is really just screwing around. Like, I really think that 90% of the investing world is for fun, okay? Because everybody knows you can't beat the index over a sustained period of time. You know, everybody underperforms the index, so why not just, you know, invest in the index? And the reason is people do it for fun. People do it for fun. So I'm like, all right, take 10% of your money, and that's your fun money, okay, and screw around as much as you want. Buy the junior mining stocks, buy this, buy that, and you'll have a boatload of fun. And if you do well, then great. And if you don't, there's really no consequences. So,
Yeah. Well, if you did that in the last 2 years in the junior mining, you probably weren't having a whole lot of fun unless you were in a few, a few selected equities. You know, I do kind of want to have a conversation quick, Jared, while I still have you for the next couple of minutes, talk to you about your thoughts on where we're at now with the market. But, let's kind of wrap things up with the book. It is a great book. I guess what have you learned about this? I mean, this is your fifth book?
fourth.
Your fourth book.
Yeah.
It's a little bit different than your previous three, but there's a little bit of everything in here. It's a little bit of a memoir in here as well, as far as being informative. What is the takeaways you personally as the author from this book, given that you've started to have, it hasn't published yet, but you have had people read it. What have you learned about this, this little very funny sector of finance and personal finance and investing in this book that maybe caught you by surprise?
Well, my least favorite book in personal finance is The Millionaire Next Door. So I read this 5 years ago when I started getting into the personal finance business, and I got 2 chapters into it and I wanted to throw it against the wall. I'm like, this is the dumbest book I have ever read in my entire life. And basically what that book says is, you're in your neighborhood, you have a house, you're living in this neighborhood, and among you are millionaires, okay? People who are just average people who became millionaires. Well, how did they become millionaires? Well, they became millionaires by cutting expenses, okay? So they ate the 69-cent canned pork and beans. They drive a 15-year-old used car that smells like cigarette smoke. They have like one cheap suit from Men's Warehouse. They just don't spend money, and they saved it and put it in index funds and became millionaires. And what I'm saying in this book is that, yes, you can do that. Like you can get to $1 million that way, but it is going to suck. It is going to suck. It's going to be miserable, right? It's a miserable way to make money. And if you think about this whole concept in general, like one of the chapters in the book is called the revenue side, okay? Where I talk about really, you can cut expenses, but like you're really not going to make a lot of progress in cutting expenses. There's only so many expenses you can cut. You grow by increasing revenues. You get a raise, you get another job, you get a second job, you work longer hours, you change careers to something more profitable, you start a business. That is how people make money, and it's a lot more fun than cutting expenses, right? So that is how people really become wealthy, is by growing. And the parallel here is the corporate world, where you have like some publicly traded company, like companies their stock prices don't go up because they're cutting expenses. When you have analysts that look at companies, they say, what is the top line doing? What is that revenue doing? Is the revenue growing? Is the business growing? And your household is the same way. You should focus on the top line. You should focus on increasing revenues.
Yeah. Well, the market always continues to reward these companies for cutting expenses, specifically in their labor market. And they've seen that last year, right?
In the short term, but it's not a recipe for long-term growth. Yeah.
Right. Absolutely. Okay. So let's talk about where we're at here now, Jared. It's Friday morning. Gold's having a nice run, about $2,065 as we talk. So that's up almost 2.25% actually. Inflation numbers came in this week, but you've got a little bit of a thought on where we're at here in the market. You have a general thesis on recession in 2024. What are you seeing here, and how's it kind of shaping your thoughts of what could potentially happen in the coming months?
Well, if you rewind back like 3 months ago when interest rates were above 5%, and everybody was bearish on bonds and said, interest rates are going to go to 6, 7, 8%. We weren't going to have a recession. We weren't going to have a soft landing. We were going to have no landing, and yields would continue to go up. That thesis was wrong. Okay. The Fed has pivoted, right? Starting with that Waller speech. So the Fed pivoted, and we're going to get rate cuts this year. And the reason we're getting rate cuts is because monetary policy was too restrictive. We had 3.5% positive real interest rates, and they had to get it back to 2%. That's why we're cutting rates. I initially had a thesis that we were going to have a recession in 2004. I'm kind of less sure about that. But the market is behaving either as if we're going to have a recession, or the Fed is going to cut a lot more than they're saying right now. Right.
Yeah.
So we got CPI yesterday, which was a little bit hot, but which I think was just because of anomaly in the data. The PPI was very soft this morning. The bond market is ripping. Gold is ripping. You know, if you thought that there was not going to be a recession in 2024, would the market be behaving this way? I don't think so.
Well, recessions typically happen when nobody's looking.
Absolutely. Yeah.
Yeah. So, I mean, and it has this exuberance with the market, especially in the tech sector. It caught me by surprise. You know, obviously, you know, our buddy Tony Greer, you mentioned earlier, he's a stock bull right now, and I absolutely get it. I mean, when you're watching the tape, there's a lot of reasons to be bullish, but when you're looking at, you know, sentiment like you do, I think I get the other half of the conversation. So what do you follow, sentiment or the tape?
Well, I mean, it's kind of the same thing. Like, sentiment is bullish at the moment. I mean, you can look at that quantitatively. You can look at like the AAII surveys. Like, people are definitely more bullish than they were 6 months ago. But it's not extremely bullish. It's not like 2021 when you had GameStop and AMC and SPACs and like Bitcoin and everything was going nuts. Like, it's bullish, but we're not at extreme levels yet. Sentiment has not become really extended. So I'm actually short. I have a small short position in the S&P, and it's going up my shorts right now. You know, I'm kind of, you know, I'm looking at the charts and I'm looking at the sentiment, and I think we should have some sort of correction, but it's not happening, you know, which gets back to the tape. Like, it's hard work being short stocks, you know?
Yeah. Well, and it was fascinating. You know, I'm watching, you know, news out of last night that U.S. and UK and whatever other countries have started bombing Houthi targets in the Middle East. And, you know, I mean, obviously it'd be bullish for oil. It's terrible for inflation. But, you know, obviously, why not buy tech? You get this terrible news. It's like buy calls. It's just like I just don't understand, Jared.
Yeah, I kind of don't get it either. That's why it's like, you know, what people have all different styles of investing. You know what I mean? And some people make money by chasing tech stocks, right? And I just have never been able to do that. I'm not a trend follower. I'm more of a mean reversion people. I fade sentiment at the extremes, and yeah, I mean, look, lots of people are getting rich in Nvidia. I'm not, and that's fine with me. You know, like I do what I do, and that's fine. So
yeah. All right, recession. You said you're a little bit less sure about it.
I am a little bit less sure. Like, I thought that you would see some deterioration in the labor market. I mean, I wasn't predicting like, you know, 400,000 in claims or 6% unemployment, but I thought you would see some weakness, and we have not seen any weakness at all, which is very puzzling. So,
yeah, no, oh man. All right. Well, we will continue to follow markets. We will continue to talk to you, Jared, as the year progresses. Again, congratulations with the book, No Worries, How to Live a Stress-Free Financial Life. There you go, the twofer. I will put the link, the Amazon link here to pre-order the book. Again, I think it publishes on the 27th. Is that what I saw?
23rd.
The 23rd, excuse me. I'll put the link in the show notes. Jared, good job, buddy.
Thanks.
Well
Order
done.
the book. Order the book. You'll love it.
Yes, I think I'm going to order a couple of them and start handing them out. So, all right. That's a wrap here today, this week on Mining Stock Daily, everybody. Thanks for joining us. We'll be back Tuesday, holiday here in the U.S. on Monday. Be well.